Welcome to Becoming Boss C. Today, we will learn the basics of accounting. By the end of this video, you will be able to answer the following questions. What is accounting? Which organizations set accounting standards? What are some types of accounting? What are basic accounting terms, such as assets, liabilities, equity, expenses, and revenue? Accounting is the measurement of an organization's business activities and economic events. Accounting is often described as the language of business because it is the process of communicating and recording both financial and non-financial information about an organization's business activities. Financial accounting is directed specifically to external stakeholders, such as investors, stockholders, government agencies, and creditors. There are common standards for accounting. Who sets accounting rules and standards? There are common standards for accounting. The International Financial Reporting Standards, or IFRS, are set by the International Accounting Standards Board, IASB, and the Generally Accepted Accounting Principles, otherwise known as GAAP, are set by the Financial Accounting Standards Board, also known as FASB. Public companies in the United States must comply with GAAP when they report their financial statements. There are various forms of accounting, such as financial accounting, managerial accounting, tax accounting, cost accounting, etc. We will keep it simple today. Today, we will further discuss the basics of financial accounting. And before we do that, hit the like button if you are enjoying this video so far, and subscribe to the channel for more informative videos. If you are already subscribed, welcome back. Now, let's go further into the basics of financial accounting. Assets are things an organization owns, such as inventory, property, machinery, and equipment. You may own assets as well. From a personal perspective, you may own a car or a house or a bicycle. These are all forms of assets. Assets may be tangible or intangible. Simply put, tangible assets have some sort of physical substance. Examples of tangible assets include cash, expected cash, such as accounts receivable, inventory, laptops, and buildings, whereas intangible assets do not have physical substance. You may not be able to see it or touch it. Examples of intangible assets include patents, copyrights, and goodwill. Liabilities are things an organization owes, also known as a financial obligation or debt. Examples of liabilities are money owed to vendors, such as accounts payable, wages due to employees, such as salaries payable, obligations owed to creditors, so think of banks or any other financial institutions when you hear creditors. Amounts due can include interest payable and funds owed to stockholders, such as dividends payable. When I was learning accounting, the concept of stockholders' equity always confused me, so I will try to explain it in a simple way that is easy to comprehend. But if you are still here, type equity equals net worth. I will explain that equation in a few seconds. Equity is money provided by or expected to be returned to owners and includes shares of stock, retained earnings, and owner contributions, such as additional paid-in capital. That was a lot, so let's break down each part of stockholders' equity now. A share of stock represents a portion of a corporation's ownership. For example, you can purchase a share of Amazon stock and become an owner of a small portion of Amazon. There are various forms of stock, such as common stock, preferred stock, and treasury stock. Additional paid-in capital is simply the difference between the par value of stock and the investor's actual purchase price. Retained earnings are those earnings that are, retained. The net earnings that are not paid to investors or stockholders through dividends are retained earnings. Now, I realize, again, this is a lot to understand. So when in doubt, just remember that equity equals net worth. In the comments below, type equity equals net worth. Go ahead and like this video while you're at it and click that subscribe button to get more videos from me. So why does an organization's equity equal its net worth? Good question. That is because assets minus liabilities equals equity. So if you take the net assets, that is assets minus liabilities, you will calculate equity. The traditional accounting formula is assets equals liabilities plus equity. Remember this equation because it will serve you well when you start learning about balance sheets. All right, next, revenue is the money earned through business activities such as the sale of inventory to customers and the sale of property, plant, and equipment. In general, an organization's goal, and I'm sure this is your goal too, is to maximize earnings and revenue. Expenses are the costs of operations, such as payroll expenses, interest expenses, utilities, and marketing expenses. Generally, an organization incurs payroll expenses because employees are typically paid hourly wages or a salary. Interest expense may be incurred when the organization borrows money from a bank or another financial institution, which is also known as a loan. Whether employees are in a factory or maybe an office building, more likely than not, the organization will incur utility expenses for electricity, water, and other services. All right. Congratulations, you know the basic accounting terms. If you are still with me, type in the comments, I am an asset, because you are an asset to your family, your workplace, and this world. I just know you are. Type, I am an asset. Now it is time to review what we learned by answering practice questions. Number 1, what is the total dollar amount for total assets? Pause the video to figure out the answer and then press play for my explanation. Let's see. We have cash, which is definitely an asset. Inventory are the goods or supplies that the organization has available for sale. Those are assets. Accounts receivable is money the organization expects to receive from customers. So that is an asset. Then, property, plant, and equipment is a long-term or non-current asset because it is not highly liquid but benefits the organization. In other words, it cannot be easily converted or sold in exchange for cash. Revenue is not an asset. Revenue represents the sales earned during the reporting period. Expenses are not assets. They represent the costs incurred during the reporting period. Treasury stock is a part of stockholders' equity and does not represent an asset. So, to get the total dollar amount for total assets, we would add cash of $1,000, add accounts receivable of $200, add inventory of $3,000, and add property, plant, and equipment of $10,000 for a grand total of $14,200. So B is the answer. Number 2, all of the items below are types of liabilities except for which of the following? Press pause to figure out the answer on your own, or continue to listen for the explanation of the answer. We have A, notes payable, B, accounts payable, C, goodwill, or D, long-term debt. If an item is a payable, that means that the organization must pay some amount to another party and the organization has a financial obligation. Therefore, notes payable and accounts payable are liabilities. Notes payable generally represent long-term liabilities that is owed to another party. Accounts payable represents money owed to suppliers or vendors as part of normal operations. Long-term debt represents a financial obligation due to another party for entering a long-term loan agreement, for example. So C is the answer. Goodwill is an intangible asset and is not a liability. What is goodwill? Let's say that company A purchases and acquires company B at a certain purchase price. Goodwill is the portion of the purchase price that exceeds the net fair value of all assets purchased and all liabilities assumed in the acquisition. So, if the purchase price was $100,000 and the net fair value of all assets purchased and liabilities assumed netted to $80,000, then the goodwill amount would be $100,000 minus $80,000, or $20,000. Moving on to number 3. Publicly traded companies in the United States must abide by which of the following sets of accounting standards when reporting financial statements? A. International Financial Reporting Standards. B. Limited Accounting Principles. C. Generally Accepted Accounting Principles. Or D. Cash Basis Accounting. I'll give you a few seconds to guess, or you can pause the video. I hope you got this correct. The answer is C, Generally Accepted Accounting Principles, or GAAP. Finally, number 4. What is the accounting formula? A, assets plus equity equals liabilities. B, liabilities minus equity equals assets. C, assets plus liabilities equals equity. Or D, assets equals liabilities plus equity. I'll give you a few seconds to guess the answer, or you can pause this video. The answer is D, assets equal liabilities plus stockholders' equity. Job well done. So go ahead and subscribe right now for more future Accounting 101 lessons. Be sure to turn on your notifications to receive alerts when I post new videos. On the next Accounting 101 lesson, we will take it up a notch and discuss journal entries, and then we will eventually discuss financial statements. There is so much to learn about accounting. As a certified public accountant, I am so excited to teach you. Thank you for watching and for subscribing to my channel. For more ways to support the channel, see the description box below. We are more than halfway to reaching 1,000 subscribers, so you can help. As always, stay blessed and stay bossy.